Today, I want to show you some different strategies on how you can avoid paying PMI on your loan with less than 20% down payment. I'm going to help you see some of these strategies. My name's Miles Pitcher. I own Superior Lending. I've been in the business now 23 plus years, 24 years. So first of all, we're talking today about private mortgage insurance, PMI. PMI protects the lender. It's insurance that you get to pay for, but it protects them. And anytime you put less than 20% down on a conventional loan, it is required. There's a lot of things that go into your PMI calculation on determining how much it is. For example, credit score is a big one. Loan to value is another big one. Number of borrowers who are on the loan is another big one. The zip code. Sometimes it's delineated by state or zip code, depending on the private mortgage insurance company, and your debt ratio, or what percentage of your income goes to pay your debts, including the new mortgage. So how much you pay in PMI can really vary based on these factors. So FHA loans, they have MIP, mortgage insurance premium, and that is mandatory. Even if you put 20% down, you're still going to pay MIP on an FHA loan. Today, we're really talking about conventional, and PMI is needed on a conventional loan if you're paying less than 20% down payment. And I'm going to show you some ways to avoid this. VA loans don't carry PMI. They're a phenomenal loan. So if you have the ability to do a VA loan, you should really consider looking at that. Okay, so strategies how to avoid this. Lender paid mortgage insurance. So there is a way that you can have the lender actually pay your mortgage insurance. And the way this works is what they'll do is build it into the premium, or it's actually called yield spread premium. In simple terms, it's paid by your interest rate. So you may have a slightly higher interest rate, but that will cover and remove the PMI from your monthly payment. So it's called lender paid mortgage insurance. The next way is to do a piggyback loan. And this is where you would do, like, say, an 80% first, then you would add on a simultaneous 10% second mortgage or a HELOC, and then you'd come in with 10% down payment. That's called a piggyback. There are 80-15-5s, but the most common we see is an 80-10-10. Do a VA loan if it's an option for you, is another way to avoid it. And then there's single premium private mortgage insurance. And this is an interesting way. It's kind of a cool way, is you can calculate how much that mortgage insurance is going to cost and pay it in one lump sum at the close of the loan. And oftentimes, not often, but occasionally we see a seller willing to give a very large credit to the buyer. And this is one of the areas where you can use that credit from the seller to buy out or remove the mortgage insurance on the loan. Pretty cool. And then there are options out there where you can get a non-conventional loan, a non-Freddie Mac Fannie Mae loan, and do 10% down and have no mortgage insurance. We primarily see these in our jumbo loans, where you can get in with a 10% down and there's no more PMI on the loan. So it leads us to the question now of how to get rid of your PMI if you are in that PMI. I'm going to post a video. I'll put a link right here at the top here that you can click on that takes you to a video that shows you how to get rid of and remove your PMI if you have PMI in place. And again, this is conventional loans. FHA loans have mandatory mortgage insurance. And so we're talking conventional. If you have any questions or we can help give you a quote, this is how you can reach my team. My name's Miles Pitcher. I'm the owner of Superior Lending.